All right, well, welcome back to the iWealth podcast, Mr. Brad Connors, and today we're talking 2024 recap.
Yeah, first of all, what happened? I mean, all of a sudden it's gone. Gone.
A lot of partying happened at the end of the year. That's what happened.
Well, that's for you. Yeah, 2024 was a really interesting year when it comes to the markets. We've had 2 straight years with really good bull markets. This bull market hit its 2-year anniversary like in October, Matt. And so, the average bull market lasts 5 years. So are we going to get 4 years or 5 years out of it, or what's that going to look like? But, S&P was up 17% last year. S&P long-term averages about 10.
Okay.
And so, we've had 2 straight years where it's been really, really strong. So
to the moon.
Yeah.
To the moon.
Yeah. I'm a little worried about people just having
unrealistic.
Yeah, their expectations.
Yep.
Yeah, just a little bit elevated, NASDAQ was fueled by AI and semiconductor type things. Like that's to technology. The NASDAQ is made up of tech stocks. That had a great year as well. S&P 500 is 500 large company stocks. Bonds didn't have a good year. So, Fed has been taking care of rates and things like that. But bonds, investment grade bonds were down 1.8%. I'm sorry, up 1.8%. But relatively speaking, if you can get cash at the bank and it's paying you 3 or 4, and your bonds are doing 1.8, that's not a real healthy investment.
Yeah, it's kind of sad on the bond side of it.
Yeah. So if you were sitting in a bunch of bonds, maybe not so happy. The 10-year Treasury yields at 4.5. We just saw here in the last week or so, us retest the highs. And so the Fed cut 50 basis points in the fourth quarter. And so what's been really interesting, Matt, is people expecting their mortgages to go down.
Okay.
Yeah. So the 30-year mortgage is based upon the 10-year Treasury. And so when you have the Fed lowering interest rates, we just expect that. We used to have 3% 30-year loans. Now they're at 7%. Like Fed cuts 50 basis points or 0.5%. Now are we at 6.5%? It hasn't happened.
Mm-hmm.
And what's gone on is the interest rate movement has been in the lower end of the curve, which means like the short-term bonds, those are dropping.
Okay.
But we've actually seen a flight to quality to the 10-year, and we're seeing that go up. And so bottom line is we don't expect interest rates to change all that much when it comes to mortgages. Like if you're holding off buying a home because you're expecting rates to be a percent lower, I don't think it's going to happen over the next year, which is pretty interesting.
Okay.
Yeah.
Anything else that we should know?
Yeah. So let's talk about 2025. We're here, and we had the election that happened last year. We know that the new regime is going to take over. I've been talking to the regime change.
The Trump regime.
Yeah. I've been talking to clients about this because I remember on both sides of the aisle, people being worried about the next change of presidency. I remember when Obama got reelected to a second term, and clients several came in and said, take me out of the market because this thing's going to melt down, like he's going to ruin the economy. And the stock market was up 11% that year or something like that. So, obviously that didn't happen. I'm worried about the opposite.
Okay.
I'm worried about people being so euphoric that, deregulation and all the different policies that Trump believes in, that he's going to implement, things like that, that this market's going to go to the moon. And that's not the way it works either. He's just one guy. The presidency doesn't make the stock market. And so I'm cautiously optimistic about next year, but I think people need to back off a little bit when they think that things are just going to go to the moon.
Yeah. And especially because last time it actually went pretty well.
Yeah.
And so they're now give us version 2.0 of last time.
Right. And it doesn't work that way. Like, things happen. We got the wildfires going on in California, and insurance costs and banking, and there's all kinds of things that happen that are outside control of the presidency. So just be cautiously optimistic. I think our economists are optimistic, but expect some volatility. And in fact, I just told JP this the other day, like I could see a 10 to 15% pullback in the next 30 days in the market. And I don't know any better than anybody else. I am not an economist. But just what's going on in this bond market, I think fund managers are taking some profits, and they're buying the 10-year Treasury now that it's creeping up and it's pushing that up. and I could see a little bit of a pullback. But I do think it's a buying opportunity. If that was to happen, I think it'd be a great time to be putting money into the market if there was a correction, which is a 10% pullback.
Very cool.
Yeah.
As far as the year that we're in now, what else should we be knowing about here and now?
Yeah, I think the main thing for you at home, like personally, these are some things that you should be paying attention to. So rebalance and diversify. We're here at the beginning of the year again. You should always rebalance your portfolio, Matt. So if you have the example is if you have 5 investments, and you want 20% of your money in each of those 5 to equal 100%, they're going to perform differently throughout the year. And so growth stocks outperformed value stocks last year. You should be selling some of the growth stocks and buying value stocks. Like, things rotate. Like, I believe a higher quality dividend paying stock this year might outperform tech. So why would you not rebalance and just make sure that things are squared up? So rebalance and diversify. Consider some bonds. I think this year is a different year than last year for bonds. I think this bond market's pretty healthy, and I think you should be able to see 4, 5, 6% rate of return in bonds as your CD interest rates go down on the low end as the Fed lowers that. And then tax strategies. It's the end of the year. 2025's here. We got a big tax policy that's coming, meaning the sunset rules are done at the end of this year. So one of the big things you're going to be hearing from the media is of what's Congress going to do about the Trump tax cuts that we had that are 10 years ago and that are going to expire. And then maintain a cash reserve. You always need to have some cash on hand to either buy an opportunity if the market goes down, or if something unexpectedly happens. You don't want to be selling stocks if it was the 15% pullback we just talked about. You want to make sure that you have some cash reserves maintained too.
There you go. Anything else that we should know for Q4?
No, it was a great year. We're expecting a good year. We're expecting volatility. But if you have any questions or need anything, just reach out to your financial advisor. They're there to take care of you.
There you go. We'll see you back here next time.
All right. Thanks, Matt.